The stock market has always been a complex web of data, sentiment, speculation, and human psychology. For decades, traders relied on experience, instinct, and technical indicators to make decisions. But in recent years, a new player has entered the arena: artificial intelligence. With its ability to process massive amounts of data, detect hidden patterns, and adapt to market dynamics in real time, AI is changing how we forecast financial markets. The question is no longer whether AI can play a role in At its core, the stock market is influenced by an intricate mix of factors: corporate earnings, macroeconomic indicators, geopolitical events, investor behavior, and even unexpected disasters. Traditional models struggle to integrate all these variables effectively. AI, however, excels in this domain. Machine learning algorithms, especially deep learning and reinforcement learning, can analyze historical market data, social media sentiment, news articles, and economic reports, identifying correlations that one of the earliest applications of AI in stock prediction was algorithmic trading. High-frequency trading firms began using AI-powered systems in the early 2000s to execute trades in milliseconds. These systems monitor multiple markets simultaneously, reacting to price movements and arbitrage opportunities faster than any human could. Firms like Renaissance Technologies and Citadel became legends in the hedge fund world, partly due to their use of advanced algorithms and data science. But while algorithmic trading focuses on speed and execution, predictive modeling in AI aims to forecast stock prices and trends. Using supervised learning, AI systems can be trained on labeled data, such as past stock prices and known events, to recognize what patterns often precede a rise or fall in value. Unsupervised learning goes even deeper, uncovering hidden structures without explicit instruction. Take sentiment analysis, for example. By processing the tone and context of financial news or social media posts, AI can estimate the market's emotional state. A surge in negative sentiment about inflation, war, or corporate fraud can signal bearish trends. Similarly, buzz around technological innovation, product launches, or government stimulus often coincides with bullish behavior. Natural language processing, NLP tools, are at the heart of this effort, enabling machines to understand not just the words. AI also plays a growing role in portfolio management. Robo-advisors use AI to assess a client's risk tolerance, goals, and financial situation, then create and rebalance a personalized investment strategy. Firms like Betterment and Wealthfront use these systems to provide affordable, data-driven wealth management to millions of users. The appeal lies in efficiency and objectivity. AI doesn't panic during downturns or get greedy during bubbles. However, no AI model can predict the market with certainty. Financial markets are partially chaotic and influenced by black swan events, rare and unpredictable incidents that can cause massive disruption. The COVID-19 pandemic, for instance, defied most prediction models. AI, despite its speed and scale, cannot see the future. What it can do is improve probability assessments and reduce reaction time. There's also the issue of data quality. AI models are only as good as the data they're trained on. Inaccurate, biased, or incomplete data can lead to flawed predictions. Moreover, markets are not static. As investors adapt to new tools, the very patterns AI identifies may disappear. This is known as the adaptive markets hypothesis, the idea that financial strategies lose effectiveness as they become widely known. Despite these limitations, AI continues to grow in influence. Hedge funds now hire teams of data scientists alongside economists. Quantitative analysis is no longer an edge, it's a necessity. JP Morgan Chase reportedly uses AI to analyze hundreds of millions of data points each day. Goldman Sachs invests heavily in predictive analytics. Even retail platforms like Robinhood integrate AI to analyze trends and deliver insights to users. Beyond traditional stocks, AI is making waves in alternative financial forecasting. Cryptocurrency markets, known for their volatility and 24/7 operation, are fertile ground for AI models. Tools like neural networks and decision trees have been employed to detect sudden market shifts, whale movements, and even manipulation patterns. Platforms like Into the Block or Lunar Crush leverage machine learning to provide analytics on token trends, investor behavior, and transaction clustering. Another frontier is reinforcement learning, a method where AI learns through trial and error in simulated environments. Researchers and fintech startups use this approach to create bots that adapt to market responses, essentially learning to trade through experience. These systems don't just analyze data, they interact with it, adjusting strategies based on changing conditions. In theory, this could lead to more resilient trading models that learn faster than humans and recover quicker from losses. Still, questions remain about reliability and ethics. Can investors trust AI models with their money? Who is accountable if an AI-driven portfolio crashes due to a misjudgment or unexpected market condition? The opacity of some models, particularly deep neural networks, raises concerns. If even their creators cannot explain how a decision was made, should those models be used to manage billions of dollars? Regulatory bodies are starting to take notice. The Securities and Exchange Commission, SEC, has begun exploring guidelines for the use of AI in trading, emphasizing transparency and fairness. In Europe, financial regulators stress the importance of explainable AI, models that provide understandable reasoning behind their predictions. As AI's presence in finance grows, so too does the urgency to ensure it aligns with investor protection and market integrity. Education is key. As more individual investors rely on AI-powered tools, financial literacy must evolve to include an understanding of algorithms, risk modeling, and data ethics. Investors should ask, where does this model get its data? How does it respond to market shocks? What biases might it inherit from its training inputs? Meanwhile, AI researchers themselves are aware of the challenges. Some advocate for hybrid models that combine machine learning with domain expertise, melding the speed of AI with the intuition of seasoned investors. Others are working on interpretable AI models that aim to be both accurate and transparent. At the same time, AI's potential to democratize investing is real. Retail investors now have access to tools once reserved for hedge funds. AI can analyze a company's fundamentals, scan headlines, interpret earnings calls, and flag risks, giving individuals deeper insights and a fighting chance in a market historically dominated by institutions. But with access comes responsibility. Just because an AI model can make predictions doesn't mean it's immune to hype, speculation, or herd behavior. Human oversight remains crucial, because while AI can recognize patterns and calculate probabilities, it doesn't feel fear or greed. It doesn't understand political instability or investor panic. It can't fully grasp irrational market reactions or sudden emotional shifts. And sometimes it's those very moments that define the market. Looking ahead, the integration of AI and finance is only set to deepen. As computing power grows and models become more advanced, we may see AI systems that not only predict market movements, but also suggest strategic responses in real time. For example, an AI could recommend rebalancing portfolios ahead of earnings seasons, sector rotations, or monetary policy announcements, automating tasks that previously required teams of analysts. The rise of quantum computing could also push AI to new levels in financial prediction. With the ability to process exponentially more data, quantum-enhanced AI might uncover patterns too complex for today's machines. This could further sharpen forecasts, optimize portfolios, and detect systemic risks before they escalate. Yet, such power also heightens the need for ethical standards, cybersecurity, and accountability. Financial institutions are beginning to realize that responsible AI isn't just about compliance. It's about trust. Investors are more likely to adopt AI-driven tools if they understand how they work and what safeguards are in place. Clear communication, model transparency, and rigorous testing must be part of any AI deployment in finance. At the same time, collaboration between humans and AI is proving most effective. The future won't be ruled by machines alone, but by teams where analysts, economists, and data scientists guide and refine what AI uncovers. It's about leveraging technology to enhance, not replace, human judgment. The story of AI in stock market prediction is not one of the magic or perfection. It's one of augmentation, of expanding our ability to see patterns, respond quickly, and manage risk with greater precision. Like any powerful tool, it reflects the intentions of those who wield it. In the end, AI is transforming the market, not by removing uncertainty, but by helping us navigate it more intelligently. And in a world where fortunes can shift with a headline, that edge may prove invaluable.